Types of statements and balance sheet terms. Accounting terms. As you progress through your agricultural science course, you should know the concepts that are relevant to keeping farm accounts and records. Understanding these accounting terms is important to completely understanding your farm's financial health and success. 3 types of financial statements. Balance sheet reports finances at a certain point in time. Income statement, profit/loss statement, reports income through a particular time period. Statement of cash flows reports amount of cash that comes in and goes out of a company through a particular time period. Financial statements provide information about your company that is analogous to the life of a tree. Balance sheet, the rings in the trunk of a tree that show the tree's growth and maturity over time. Income statement, the fruit your tree produces. Cash flows, the water that is the life source of your tree. Balance sheet summary. Assets, something that you own, such as cash, inventory, equipment, land, buildings, vehicles, livestock, accounts receivable. Liabilities, what you owe to others, such as loans, credit cards, accounts payable. Owner's equity, your ownership in the business, past year's retained earning, owner contributions, and investor capital. Assets equal the liabilities plus owner's equity. Owner's equity equals assets minus liabilities. The net worth, or the owner's equity of my farm, is what it owns minus what it owes. Assets. A farm asset is anything of value in the possession of the farm's business. Assets can be fixed or current. Current assets. Current assets are assets which are used up during production. These are farm supplies involved in the farm's production. They need to be replenished. In agriculture, examples of current assets are agrochemicals, seeds, water for irrigation, and cash that is in the farm's bank account. Fixed assets. Fixed assets are assets that are not used up during production. These are the capital inputs of the farm and can be used for multiple years. In agriculture, examples of fixed assets include farm buildings, tools, vehicles, machinery, and landed property. Appreciation. An asset that grows in value over time is said to appreciate. Appreciation increases profits as the cost at purchase is lower than the cost at the time of sale. In agriculture, examples of appreciation include purchases of land, livestock maturation, and the cultivation of cash crops, crops grown for commercial value instead of the farmer's use. Depreciation. An asset that depreciates loses its worth over time. Depreciation demonstrates the loss of value in the market due to age, wear and tear, and/or the demand for the asset. In agriculture, farm machinery, tools, vehicles, and technologies are significant assets that depreciate over their lifetime. Useful lifespan. The useful lifespan is the number of years that an asset such as a piece of machinery can serve the farmer effectively. The best agricultural example of a useful lifespan is a tractor or other vehicle. The vehicle can only serve a farm efficiently for a number of years before the costs of repair are greater than the cost of replacement. Salvage value. The salvage value of an asset is the amount at which it is more economical to sell off the asset than to repair or maintain it. The amount that you would obtain by salvaging the asset is the salvage value. Calculating depreciation. Since the value of an asset can depreciate over time, the loss of value can be deducted as a business expense. In some countries, that decrease in value is deductible from annual taxes. As of fall 2021, Nigeria does not currently allow for depreciation as a tax deduction. It is still helpful to know how to calculate yearly depreciation for your farm's accounting. Before calculating the amount of annual depreciation, you have to determine the total amount of depreciation. To do this, subtract the salvage value of the asset from its cost. For the purposes of this illustration, let's assume that a farm's tractor originally cost $200,000. The farmer determines that the useful life of a tractor is generally 10 years, and the salvage value of the tractor is $50,000. The easiest method to calculate annual depreciation is to divide the total depreciation by the useful lifespan. Annual depreciation equals the original cost minus salvage value, which is $200,000 minus $50,000, and divide that by the useful lifespan, which is 10 years. and we get $15,000 per year. Annual depreciation equals $15,000 per year. Liabilities. Liabilities are monies owed to outside individuals, agencies, or businesses such as banks. There are two types of liabilities, short-term and long-term. Short-term liabilities are also known as current liabilities. These debts must be repaid within one accounting year. In agriculture, examples of current liabilities include purchases on credit, taxes owed, long-term liabilities due, and unearned revenue, such as a deposit made in expectation of a product delivery. Long-term liabilities are debts that cannot be paid within an accounting year. In agriculture, example of these debts include loans to purchase land, buildings, new machinery, and large or expensive equipment. Net worth. Net worth is the complete worth of an individual, household, or company. Net worth is the value of assets and liabilities combined. Assets minus liabilities equals net worth. Owner's equity. Owner's equity is the portion of the net worth of a business that is attributed to each owner of the business. That's the owner's share of the net worth. Equity can include stocks and other non-liquid assets. Liquidity. Liquidity is the ability of an individual, household, or business to pay debts as needed. An asset that is liquid can be easily transferred into cash to pay debts directly. In agriculture, machinery and harvested crops are assets. However, these assets are not liquid. For those assets to be liquidated, they would need to be sold for cash. Solvency. Solvency is the ability of an individual, household, or business to pay debts after liquidation. A solvent entity is able to eliminate debts after the assets are liquidated. In agriculture, a farm is solvent if it no longer has liabilities after its assets are liquidated.